Good afternoon and welcome. I'm Reena Agarwal, Robert E. McDonough Professor of Finance and Director of the Georgetown Passaro Center for Financial Markets and Policy. I'm delighted to open today's Passaro Center webinar on Bridging the Divide, a bipartisan dialogue on digital asset regulation, where we will explore the regulation of digital assets. We are honored to host this bipartisan dialogue with two incredibly distinguished speakers who bring a wealth of experience and insight from both sides of the aisle. Patrick McHenry, Passaro Center Distinguished Fellow and former chair of the House Financial Services Committee, and Rostin Behnam, also a Passaro Center Distinguished Fellow and former chair of the Commodity Futures Trading Commission. Moderating today's discussion is Bloomberg's Sonali Basak, whose reporting has been at the forefront of financial markets and policy. This conversation is not just timely, it's essential. It's a privilege to have the former chair of the House Financial Services Committee, Mr. McHenry, who has played a key role in introducing legislation related to financial technology and policy. And also, Russ Behnam, as a regulator and a former chair of CFTC, one of our most important regulatory agencies. As digital assets continue to reshape the financial landscape, the need for thoughtful bipartisan dialogue has never been greater. Today's discussion will focus on the near-term regulatory challenges we face, and more importantly, how to meet those challenges with solutions that foster innovation while also safeguarding consumers and the broader financial system. The goal of today's event is to move the conversation forward, to highlight the progress that has been made, to acknowledge the gaps that still exist, and consider how a clearer regulatory path can support both economic growth and market integrity. So thank you for joining us. We look forward to an engaging and productive conversation. With that, Sonali, I'll turn it over to you.
Thank you so much, Professor Agarwal. And Russ, Patrick, it's an honor to really talk to you today. I've covered both of you for a very long time in your respective roles at the House and, of course, at the CFTC as well. And we are on the brink of so much change. Perhaps let's level set for a moment here. We are 100 days into a new administration. We are looking to the future of new regulation in the digital asset industry. What do you think can change from here relative to where we sat before? Maybe, Patrick, you can get started given all the changes that are going on in Congress right now.
Well, there's a huge amount of change. Sonali, I think you've covered this very well, but post-election, there has been an awakening that regulatory policy and legislation can make their way through to give better form and structure to the digital asset ecosystem. We're late in coming to this as a country. Europe has a standard well ahead of ours. Asia is well ahead of us in regulatory policy as well. So we've got a lot to catch up on. Innovators want to be here in the United States. They want to deploy digital assets. Those that are currently regulated want to be able to deploy them. Innovators want to be able to build tools that can be broadly and readily used. So there's a great deal of interest, but the election was the pivot point here. And you have a new set of leaders in the executive branch from the White House that are interested in getting sound law for digital assets. You have leaders on Capitol Hill in both the House and the Senate on a bipartisan basis that want to get legislation done. So it's go time. It's go time for digital asset policy. And this is going to be a wicked hot summer of legislating. And it's going to be fun to cover it.
For a reporter that's been caught up in the wicked hot year it's been so far, I'm looking forward to keeping up. Now, Russ, when you think about the types of rules that might be created, all the laws that might be created around the digital asset industry, what's the good, the bad, and the ugly? As somebody who's run one of the largest regulatory bodies when it comes to financial services.
Thanks, Sonali. And on the one hand, as I've said before, you and I have had this conversation many times, there are gaps that have to be filled. And as Patrick said, I think that's going to be a huge first priority for Congress, is to sort of view the landscape, see what the playing field is, see what some of the innovators and companies are doing, even both traditional financial institutions and some of the newer players. What are they doing? What are they hoping to do? Where does existing law cover those activities? Where does existing law not cover those activities? And what tools do the regulators need, both the market regulators and the banking regulators need, in order to comprehensively regulate the space? And from a regulator standpoint, you have this mission and core responsibility, of course, of protecting markets and protecting customers. And when you don't have those specific tools, as technologies emerge, as technologies evolve, and you're faced with a new landscape or a new playing field, it makes it very difficult to do your job. And you feel, of course, a responsibility on your shoulders to make sure you're fulfilling this mission. And that intersection between Congress and the executive branch becomes extremely critical. It was a relationship Patrick and I had when we were both in our former seats. And I hope and I would imagine that the new individuals who are in our chairs and others across the government are going to be able to have a conversation, be transparent, and be honest about what tools the regulators have, what tools the regulators need, and making sure Congress to enact new laws so that the regulators are in a position to properly regulate the market, balance the need for customer protections and a rigorous regulatory framework while allowing innovation and growth in the market. There's a lot of different calculations and externalities that are at play, and it's going to be striking that balance between what Congress writes and what the regulators are ultimately able to implement through rules that I think is going to give the industry, as it has any other industries historically, a path to grow, a path to participate in markets, and to use our U.S. capital markets as a real strength for them to grow their businesses here in the U.S., but also abroad.
I think of how much has happened over the last 10 years. I've covered crypto for 10 years here at Bloomberg. How much has changed and some things that have gone wrong, right? In the absence of lawmaking, FTX had happened. But also in the absence of lawmaking, you have still seen tons of crypto companies soar. And as we sit here today, Bitcoin itself is closer to $95,000, right? So Patrick, you now are working with other companies, right? You have secured work with A16Z, Lazard, other financial companies here. But A16Z is particularly interesting because they are very closely tied to those young, innovative companies that might define the future of crypto. You think about the rules that could be made ahead that will define the way this industry progresses. What is there to guardrail against at this point, given what we know now?
Two things. First of all, the bad actors in this space that are out to steal people's money. And let's be honest, in every financial innovation, there are bad guys that come in and play to take people's money. That's happened in crypto. We've seen big examples of that. We'll continue to see examples of that in all financial products, but specifically in new innovations. So we have to ward against that. That's the reason why we need clear rules of the road. That's one. And then two, we have to guard against bad government regulators that do not want to do their work or do not prefer this innovation. That was what happened with the Securities Exchange Commission under the Biden administration. It was a willful decision by the SEC to not permit new products, to not actually police very well either. So we had the worst of both worlds with a bad regulator, one that would not say yes to innovation, and also at the same time do a bad job of policing bad actors. So we had the worst of both worlds. So we have to guard against fraudulent bad actors, number one. And number two, we have to guard against regulators doing something wrong. That's why we need sound law. Those are the two driving forces to sound law. Sound law from Congress is centered around decentralization as the key innovation of digital assets. It takes into account the differences of the different types of tokens we have, the difference between these different types of innovations. But decentralization has to be the key part of law And law is going to be the thing that ensures against regulatory overreach on one account and policing its bad actors on the other account.
Now, Russ, if you think about your former agency, the CFTC, I always felt sitting on the other side that it was gaining more and more influence in crypto. It wanted to expand its oversight when it comes to the crypto universe. How do you phrase that desire from where you sit now, both in terms of how you took an approach to the industry and where you see the CFTC going? Do you think it has room to play a much bigger role when it comes to the development of crypto?
Yeah, I mean, when you're in the jobs that I had, as I said this in the first response to your question, you are given a mandate, you have a mission, and you feel a strong, heavy weight on your shoulders to make sure you're doing what you can to fulfill that mission. And there's a history to it, and there is a legacy to what you're going to do and how you're going to move that agency forward. And when you don't have the tools to perform and to execute that mission, it is a unique feeling, and it's a frustrating feeling, right? So I started at the CFTC in 2017 as a commissioner in the first Trump administration and ended just a few months ago as chair in the Biden administration. And over that 7-year arc, as you sort of pointed yourself, Sonali, huge change in the crypto space. From a CFTC perspective, the emergence of the first Bitcoin futures contracts in December of 2017. And then a gradual but still slow and steady growth of participation by traditional financial firms, newer financial firms coming into the CFTC space. Certainly a disastrous 2022 with number of failures, FTX and others, that not only put a lot of onus on the regulators to be a step ahead, but also a challenge for the industry to rebound from that moment. And as Patrick said, and we deal with this in all industries, there will always be bad actors. There will always be individuals and institutions who try to expose loopholes and take advantage of weaknesses in the regulatory system to steal customer money. But from my standpoint, we are a commodity regulator. We have limited jurisdiction over cash commodity markets across any cash commodity market, whether it's agriculture, energy, or metals. And we see this emergence of a new technology, which manifests itself in the form of trading commodity assets, Bitcoin, Ether, and other tokens. So where you have multiple regulators who have worked very well together over the course of 50 years, but you have gaps between the two market regulators. And we have to fill those gaps because you have an emerging technology, you have new participation, you have demand and a heavy desire by both retail and institutional investors to participate in this market. You need to see the evolution of the agency. And that's really what I was articulating and calling for a number of years, going back to 2021 when I became chair, is I need new authority as the head of this agency in order to properly regulate and ultimately enforce rules around this marketplace. And the balance always became, do we want to legitimize this industry, this burgeoning industry that has a lot of weaknesses and failures and bad actors, with the imprimatur of the US regulatory system, one that is respected across the globe? And I think in balance, as I sat in my former chair, it really was the anchor, the North Star was about protecting customers. And I saw continued growth and desire by retail customers, institutional customers. And in the end, we have to let the customers decide if they're going to participate in the markets or not. But to not move and to not act from a regulatory perspective is in of itself, I'm going to give credit to Patrick for this, the loophole. Because if we continue to not legislate around this, then you're going to have these gaps in regulation. So I do see the CFTC moving forward and having a very significant role. And that is by virtue of the two agencies and what their jurisdictions are. This definition of commodity and security has to be figured out, both by Congress, but also by the agencies. And when that is filtered through, then I do think you're going to see the CFTC with an improved and also expanded authority over cash digital commodity markets, which in the end will benefit customers first and foremost, but also those who are trying to innovate and start companies so that they have clear rules of the road.
The age-old security versus commodity issue. I mean, Patrick, maybe take a stab there.
This is what's so fun about this space, right?
Right.
Right?
Well, when you look at your longtime colleagues in Congress now, how do you think they hash this out and close those loopholes? We've been waiting for that answer since the inception of the industry.
Well, look, I mean, look, this is the great conversations that Russ and I had, which is a substantive debate about how this stuff works. And so, we went through this process in the House to develop a frame of reference, and we tried to be scientific about it. And eventually you get from science to art. And this is where, because Russ was sitting at the CFTC without a willing partner at the SEC, that they couldn't just hash it out. And if you had like a Russ Behnam at the CFTC and a Russ Behnam at the SEC as chair, they could go work out a reasonable set of rules around the distinction of a digital commodity or digital security. What we came up with on Capitol Hill, and I credit French Hill with digging into the details of this, and my staff and team, was we wanted to have a fit for purpose piece of regulation, meaning if a token looks and acts in these ways, it should be regulated in these ways. And we have this as a basic notion that everyone agrees with, that a stable coin should have a different set of regulation than the rest of crypto. And a stable coin is a payment product, is a payment mechanism, so therefore should have a payments regime. Likewise, for tokens, we have to classify these tokens in specific ways. And what is a network token versus a security token, meaning to secure a cybersecurity token, versus what is actually, in essence, a tokenized security, right? There's distinctions within all of these different tokens, and they should be regulated as such. But it's gonna separate from science to art in order to get a piece of legislation through the House and Senate and signed into law. And then after that hard work is done, the harder work of the agencies making rational decisions that the market and innovators can understand is going to be a very, very difficult challenge in a really dynamic marketplace.
I think what's hard for a lot of the industry is those technology companies want to move a lot faster than Washington does. And in the meantime, when you think about tokens in particular, it's not only the fact that you've seen an influx of tokens, particularly since the election, you also have major firms like Kraken and Robinhood being very vocal on our network and others about the idea of tokenizing other types of assets, private funds, even to a greater degree. Russ, how do you think about this? The industry wants to move so quickly, but a lot of these definitions have not been sorted out. What's the risk, and how can Washington move a little faster here? Is that fair to ask?
Yeah, it's a tricky situation, and again, one that I dealt with, but I think one that the current regulators, both market and prudential, are going to have to deal with at a much different level. And there are mechanisms within the regulator power or suite of tools to provide either safe harbors or guidance until the final rules are fleshed out. And from a CFTC perspective, it really was and continues to be about a lack of authority to write rules around the crypto space, specifically the commodity space. I think Bloomberg reported earlier this week that the current SEC chair believes that a lot of authority already sits within the SEC around the crypto space. So one would expect, given the work that the agency has done, and I think Commissioner Peirce on a number of requests for comments, you're going to see rules being proposed over the next couple of months. It's going to take time for the staff to do it, but it is a little bit of getting the cart before the horse, where you can't stop the industry from doing what it's doing, whether it's trading the tokens or developing protocols and whatnot. And that's been going on for years. And you're using these limited tools from an enforcement perspective as a little bit of a shadow over the market to ensure that they know, regardless of perhaps a lack of clarity around rules, you do still have a law enforcement mechanism in case there are bad actors or in case there are individuals or institutions who are violating the law. So it's going to take a while. And as Patrick said, we're at a 100-day mark now. We're seeing progress on the stablecoin legislation. The market structure bill, which we should talk about, is probably going to be many months away. But then it kicks over to the harder part where you're going to have the market regulators and the bank regulators writing rules, which often can take over a year, even at the quickest clip. So then you leave a large amount of time where the industry is kind of caught. And I don't think they're necessarily going to slow down, but I would hope that they understand the dynamics of the civil enforcement authority and what it means to do the right thing so that the industry ultimately can stay on course.
Yes, we'll do this with the rest of our time. We'll talk about that stablecoin bill. We'll talk about that market structure bill. Before we do, though, many of us, all of us here certainly remember the Jay Clayton era at the SEC, the first Trump administration. That really was when you saw that first ICO boom. Patrick, do you worry at all that we're going to see ICO 2.0?
Not until there's clear law here. I think we're going to see a bill out of the House in the next 2 months, crypto market structure bill out of the House. For those that are real innovators, I think you want to wait for clear law, clear rules of the road, and so you can use those new rules to the maximum extent possible. The ICO boom of a previous era does not conform with the realities of the current marketplace, the needs of the current marketplace, nor the technology that is being used. So in many ways, it's not as necessary as it was, during Trump 1. The second piece, as I vaguely mentioned there, which is if you're an innovator, is it worth waiting 2 or 3, 4 months to figure out what is the actual best pathway for you to get the maximum value of a new network or a new token? I think it's worth waiting. And so I don't think this is going to be a fall exercise. I think the president is really interested in getting a bill to his desk before August recess. And I know my colleagues in the House and Senate are trying to perform to the president's desire on that date. So I do think we'll get clear rules of the road, and I do think it's worth waiting rather than innovators taking a great risk, a great policy risk for something they can otherwise be more methodical about.
Let's open the gates. Let's open the gates to this market structure bill. Russ, when you look at the way that this is being parsed out right now, what do you like? What don't you like?
Well, look, the number one thing I like right now is that there's a serious conversation, and the direction of travel seems to be that the CFTC is going to get new authority over commodity digital tokens, which, as I've said many, many times, in terms of the quantity of tokens, they may and are largely probably more security tokens on one side of the ledger than commodity tokens. But when you look at the actual market cap and the size of the digital ecosystem, whether it's Bitcoin, ETH, and a few others, you're talking about 70+% of the market capitalization of the market. And that was the thing that worried me the most as a former regulator, is that you have this huge swath of the market living in a regulatory vacuum. And there were multiple, entities who took advantage of that space, that arbitrage opportunity. So I do like that. I do think that there has to be one of the trickier things is going to be striking the right balance. And I look forward to seeing a second iteration on top of and following Patrick's Fit 21 bill last Congress to ensure that there are no loopholes for the securities laws, to ensure that the regulators have clear direction from Congress, which is always, always, always very important, but also preserving sufficient flexibility. And I think as a regulator, that is a key element. Sonali, you mentioned this and suggested it multiple times, that the industry is constantly evolving and technology is constantly disrupting itself. And with that, the regulators are always going to be at least one step behind, if not more, and preserving and ensuring that there's some level of flexibility at the executive branch is so critical, so that if and when things do change, the agencies can continue to evolve with advised or amended rules, as opposed to having to go back to Congress all the time and saying, hey, this is a little bit outdated. Can you update it with a new version? That is very difficult. We've seen that over the past couple of years. So striking that right balance is key, and making sure that the authorities are provided, but also flexibility for both agencies, given the existing law that they have applied right now.
Right. I mean, to that account, what we did with FIT 21 last Congress is define to the best extent possible decentralization. And that was the core of what FIT 21 was, and I think is. This is the clear rules of the road, so that, as Russ said, what he would be able to do at the CFTC is provide really effective market surveillance and consumer protection in a way that doesn't currently exist for digital commodities. That makes a whole lot of sense. Well, you have to define this based off of decentralization on what is actually in securities law versus what is in commodities law, in my view. So how do you define decentralization? Well, we did it through a set of measures that was a test. The market has changed since we wrote FIT 21 and passed out of committee 22 months ago. The better way to do that now is to have still decentralization, but the most effective way to determine decentralization is control. Who controls it? If it can be controlled by a small group, then it's a security. Come on, get over it, right? And if it's not controlled by a small group, then it's a commodity. Let's make it a simple, straightforward test that you can't game and that is not complicated. I said simple and ended with not complicated. So I'm trying to reiterate myself to the world here. So I think that is important to focus on. That is the key tenet of market structure. I think you can also go a step deeper now in this lawmaking exercise with market structure and get into a question of token classification. Classifying tokens based off their utility and their purpose and regulating them according to their utility and purpose. So token classification could be an addition to the market structure bill that we passed out of the House last Congress. And I think those are useful things for policymakers to take account of now as they're moving the bill through committee.
So I have a controversial question then. So what is a small amount of holders? Because one thing I think about a lot in Bitcoin and even Ethereum markets, but certainly for Bitcoin, is what happens if you have a scenario where fewer and fewer people own more and more of the stock of Bitcoin outstanding. You think about giants like MicroStrategy that are built to amass more Bitcoin. Is this a dynamic that both of you think about when you're thinking about classification?
I would say, when I think about the test or the line between commodity and security, it's less about who's holding it and more about who has the rights. And this is what Patrick was alluding to make decisions that drive the future of the financial instrument itself, right? And security, using a security, we talk about the how we test a lot. And this is what Patrick was alluding to. If you have a small or large group of people making decisions, which essentially determines the course for the underlying asset, then you're having decision makers and you're having that line between a security where you have an investor who has an investment of money with an expectation of profit from the work of others. Bitcoin is decentralized. There's no single individual making decisions about the token itself. Whether or not there's one large holder, two large holders, or a significant group of large holders, it's something to consider about market manipulation and the secondary market. But when you're talking about the primary market and the issuance of it, the token itself, that's a different set of questions. And I think that is something the SEC has thought about for many, many years. So always having to look at insider trading, market manipulation, and how people, use markets to their advantage. But really, when we think about that primary market, the question really should rest on what I believe, even though 80 years old, is a test that is durable and one that might need slight adjustments. And I think Fit 21 did add some parameters around essentially the core of Howey to think about the unique and distinct characteristics of digital assets that would need to be considered by the regulators when they make this decision between commodity and security.
I agree, and I think the issue here is control, and where there is control, you should have updated smart regulation around that. But we know how to do that. When you have a controlled instrument, we know how to regulate that. We can improve it with better techniques and technology, yes, better regulation, yes. But where there is not control, you have to have a new regime, and that is the world that actually Chairman Behnam knows better than I do, how you can actually have smart consumer protection in a commodities regime. Those are modern techniques that we can use around digital commodities. But where there's control, traditional gravity should act on them. But where there is not control, you have to define what control is, and I leave that to my friends in the elective office and in the important offices here to negotiate exactly the contours of that. But the general idea is one that has to be deeply baked into the policy and made clear to the market.
Okay, then the toss-up question is staking control?
Go ahead.
So look, this was an issue that I dealt with, and I think in this conversation around, again, security versus commodity, specifically with ETH and the Ethereum network, it is really about that return, that investment of money with an expectation of profit. And I do think in the world where you can stake tokens, it does raise very serious questions about whether or not that asset is a security, because it certainly has the characteristics of what a security are. But just because you can stake an asset doesn't mean you have to stake an asset. And that's another interesting question that you typically do not have in the sort of current traditional financial ecosystem, where you can or cannot stake an asset, right? This word itself is unique. And then, there's going to be a large segment of holders who just hold, let's use ETH as the example, the best and easiest one to use, who don't stake the asset and hold it in a more traditional form, which I've argued, there are listed futures on ETH, is a commodity. But if you are choosing by virtue of, access and the right to stake ETH, then I do think that does raise a new set of policy questions that both Patrick's new colleagues and successors, and then my successors, will have to think about.
I don't think it meets the test, and I think staking has become a part of the marketplace, and the facts on the ground indicate that it can occur without changing the fundamentals of a network. But what I would say is we actually need to make sure that those are safe and sound practices, so that owners of the asset have consumer protection. I think you can smartly do that.
So perhaps we can double down on DeFi itself too. You kind of raised, decentralization as a really central theme here, so to speak. What are the risks, Patrick, from where you sit around decentralization, particularly given how much the industry wants it to go in that direction?
Well, it is the value of crypto. Decentralization is the true technology innovation here, of broad coordination through technology, and so DeFi. I think what a bad outcome right now for DeFi is a government policy killing it. DeFi could change the way that we get lending, that the way we can actually have real world assets owned by individuals in a mass way. It is a great way to actually level up our marketplace around sophisticated financial products that can be meet mass adoption. That's not yet here, but it is an attribute of DeFi that has long-term durable value. And if we get it wrong now, we're going to kill that innovation that can arise later. So I think DeFi is hugely important, and for Congress and the and the regulators to not mess it up is my primary focus and concern, because there's real innovation here that needs to be fostered and enhanced. Having said all of that, our traditional view against acting against money laundering is very important as well. So we have on-ramps and off-ramps to the digital asset ecosystem that do a very sound job of rooting out money laundering. And an open permissionless ledger is a horrible place to try to launder money. And so I think we can police this in a very smart way and still allow DeFi to flourish for the long term and the long-term good.
Sonali,
go ahead, please.
Just add a thought. One, it makes me think about, the collective public has been consumed by the speculative nature of digital assets, right? And for good reason. It catches attention. There's been some great falls over the past couple of years, but as Patrick suggested and alluded to, there is an underlying technology that is essentially driving this ecosystem, this token ecosystem, which then leads to the trading of the assets. So there's a lot of interesting. I did not focus on those particular issues when I was chair of the CFTC. That was not the remit of the agency or my job, but there is something that sort of is kept in the shadows, I think, by virtue of the louder noise that the speculative nature of the tokens seems to have and manifest. And I think that's going to be interesting to see evolve, because it is very early days for that technology. And it is going to continue to prod on, and rules of the road, I think, will facilitate growth and where it goes. And it can be very disruptive, both on the beneficial side, but on the risk side to traditional finance and the rails and the plumbing that really drive our financial system. The second part, very quickly, is where does this fit, a decentralized financial system, fit within the current regulatory system itself? Because we are not accustomed to that. We are accustomed to a very centralized financial system where you have very clear intermediaries and exchanges and custodians and clearinghouses all along this sort of value chain of the financial plumbing system. And I think this is going to be another very tricky question, one that I've thought about, Patrick and I have talked a lot about, is where and how do you strike the right balance between understanding and appreciating the unique characteristics of a decentralized system and why it's unique from a centralized system, and why it doesn't necessarily necessitate the same regulatory vigor or requirements, but on the other hand, certainly cannot live in a regulatory vacuum, right? And I think there are some participants in that space who believe that is and should be the case. But I would say, exhaustively, it sounds like Patrick agrees, and I hope Congress and the regulators will follow suit, is that regardless of the decentralized nature of any new or 2.0 that might come down the road, there has to be some very clear, important intersections with the regulatory system. The on-off ramp, AML, KYC, BSA is critical, but there are also other components from a market standpoint in order to truly protect customers that have to be implemented in a decentralized world.
I mean, as someone who's a financial correspondent at Bloomberg, I think about this constantly, because you wonder what the role of exchanges as we know it today will be versus a decentralized exchanges and banks, let's say, versus all the decentralized activity that's happening. Patrick, my question is, how much does the market structure bill actually solve for these giant questions around how this new financial ecosystem is supposed to work? Especially because it does, the way that crypto is evolving, it's ending up serving a lot of different functions for, you could argue, a new generation.
So I think the bill that French Hill is working on, the finer points of, and what was Fit 21 and what will be the new Fit 21. I think that is a far more rigorous product than the 33 and 34 acts. So, I mean, and I think this is a more deeply contemplated product than what we view as our hallmark rules of the road for securities. Okay, that may be you may push back on that, but it is much more finely designed and thinking about the secondary effects than I think what they did in 33, especially. So does it cover all the subject matters necessary? No, it's not, because we actually have regulators that can get into the finer points of policy, but it has to be the broad thrusting of what is a commodity, what is a security, give them a home, give them direction on how to write regs commensurate with that law and that decision making on based off of decentralization. I think it's going to take care of that and a whole lot more. And will give rigor and structure to a marketplace that desperately needs it and would benefit from it.
What does the industry have? And this one's for you, Patrick, again, because now that you're working with companies on the other side too, A16Z and others, what don't they get, right? What would they have loved to see in this bill that they might not see this time around?
Well, look, there are a lot more players participating in this round of policymaking on Capitol Hill. French Hill's job leading the Financial Services Committee is different than mine, and we're just one Congress apart. Different challenges, different opportunities, but certainly the challenges are significant to sound legislating. We have folks that are desperate for clear law, and that is by and large the most significant actors in the world of crypto. You also have folks that say, actually, we're okay. We'll just get good regulation under the Trump team. The marketplace will be up and running, and then a bad regulator won't be able to kill us then. I think that's misguided. I think that's wish casting rather than being practical. Let's get sound law now. Let's ward against bad regulators taking these seats that could try to kill digital innovation. And that's what we had for 4 years under the Gensler regime at Biden's leadership. Now that's not the regime over at the CFTC under Chairman Behnam, that's for sure. But you can see the difference in interest, agenda, and capacity between just. I'm not trying to preach your book here, Russ, but the way that Behnam operated the CFTC versus Gensler operated the SEC. Consensus-driven process over the CFTC, strong agenda, and Russ, you and I have had our disagreements on the policy, but I knew you were actively working both for the soundness and of the marketplace, consumer protection, and innovation, and the societal benefits of these products actually working. That was missing over the SEC. So you have to have sound law, and that is one of the touch points within crypto right now of this debate. Is regulation good enough, or do we need law? I got to tell you, you have to get it. You have to get sound law, and you have the opportunity to get really sound law under Chairman Scott and Chairman Hill off of Capitol Hill, and I think you should take it. So,
Russ, going back to where we started to go at the beginning, I felt us trying to push ourselves into this part of the conversation, but I do want to start to get to stablecoins now, because of course that is where we're seeing a lot of progress in Congress. And from where I sit, I'm even talking to banks all over the place on how they want to play a bigger role in this industry. Payments companies, certainly. How does stablecoin legislation change the rules of the road? It's pretty incredible to see the way the industry is taking to it in different ways.
Yeah, the interesting thing from my vantage point about stablecoins and going back a few years in terms of the conversations I was having with my colleagues in the Biden administration was you had this growing market, roughly, let's call it 2 to 3 years ago, 125 billion to 150 billion of reserves, most of which were held in U.S. Treasuries. And from a U.S. financial regulator standpoint, that's a red flag. Certainly from the CFTC, but you can imagine from the Treasury Department itself, who's issuing this type of debt, if you have a single player or a single ecosystem or a few players, amassing that size, which, in the grand scheme of the treasury markets is actually quite small, but it's new. And the technology is new that they're participating, at least that inflection point with the treasury market. That was really, from my standpoint, the impetus which drove Patrick and Congresswoman Waters' drive to get a stablecoin bill out first as soon as possible. I also think it's much simpler. It's not simple, but it's much simpler than sort of the complexities of a market structure bill. The other component of the stablecoin bill is really what stablecoins are and what they accomplish in terms of driving more efficient, lower cost payments. You have to think about the current rails we have under our current banking system and what opportunities stablecoins provide. Now, with those opportunities comes risks, much a theme for our conversation, bad actors taking advantage and capitalizing on a regulatory vacuum and the ability to get exposure to stablecoins, whereas the on and off ramps to traditional fiat are much more rigorous and exist in a way that bad actors certainly can do it, but not as easy. So we have these exploitative factors that are driving the growth in part of stablecoins and the desire to regulate it and to have transparency. And with that, I just want to turn back, but an aligned point. Patrick mentioned what Chairman Hill is dealing with now, and Chairman Scott and the ranking members as well, very different than what he was dealing with, because you now see a path to regulation. You now see a path to legislation being passed and signed by the president, and then regulation being implemented over the course of 1 or 2 years. And when that happens, then you start to see the traditional players come into the scene, right? And you always observe them on the margins of the screen when the regulation, there was uncertainty around it and whether or not there would be progress. But it clearly sort of suggests that the traditional financial players see potential benefits. They see an opportunity to make money. I think the ETF is a great example. That IBIT launch was historic in scale and success, really demonstrated the desire by retail investors. So when you add on layers about stable coins, potentially crypto and the underlying technology and DeFi, you're seeing a lot of players, whether it's big SIFI banks or smaller institutions wanting to complement the existing rails with a new system that could facilitate better payments, better settlement, and ultimately a more vigorous financial system.
What do you make of this? I mean, in addition to all those points, you could say there is a chance for it to make the payment system a lot cheaper in the United States too, in terms of peer-to-peer payments. But how far does this go now that the gates are kind of being open to this industry? And does this lead to a lot of new questions about how the financial industry evolves, Patrick?
No, I think without sound law, you're not going to have the most significant players in the world of finance use these products. They want clarity, and they don't want clarity for a term or through the midterm. They want clarity to build a business, and you're not going to go spend major capex on building something for on a temporary basis. That doesn't make a whole lot of business sense. So, what's happening in the world of stable coins is a firm desire to get federal law that's sound, that's modeled after the New York State approach. I think the Genius Act and the Stable Act are two very good products. I think there's a lot of decisions there that are major touch points. And how do you deal with the domestics? How do you deal with the international stable coins? And having sensible regulation in a way that's similar to how we regulate international banks versus domestic banks. And I think there are reasonable decisions that can be made there on a regulatory structure on stable coins. But there's more work to be done there, but a great deal of interest across the world of finance to deploy these products.
Yeah, I mean, what is still uncertain to you? And you've given such clear timelines in terms of how you think the market structure bill, for example, will be played out. Similar to that type of timeline guidance, what can you say in terms of the future of stablecoin clarity in the U.S.?
I think the Genius Act and the Stable Act are 75% similar policy, maybe 85% similar policy. I think you have a couple things that are quite sticky on how you deal with it. Who is the appropriate regulator? I'm sorry, what is the appropriate regulatory agency, not who? And a lot of the decisions we made last Congress were based off of who actually sat in those regulatory seats, driven by politics. I think we can be this Congress can be much more methodical about that, and get the proper regulator for a product at the federal level that stands and competes with state regulated products. So much more competition among the regulators, a lot more choice out of this. Number one. Number two, I mentioned this about the international stablecoins versus the domestic stablecoins. There's a major brewing battle between the domestics and Tether. Tether being the largest dollar-denominated stablecoin in the world, asset-backed, just like all stablecoins. How do you regulate a Tether for U.S. persons? So you have Circle has a strong view and a conviction about that, driven also by their power in the marketplace. Tether likewise has power in the marketplace internationally, but not domestically, and both are very interested in being going concerns after law is passed. And they're both working actively on Capitol Hill to make their point of view heard. But I think the reasonable outcome here is that Tether will exist post a stablecoin law in the United States, as it should. You shouldn't blow up an international product that desires to be dollar denominated. I don't think that's a rational outcome. And likewise, you're going to have, if you're going to touch U.S. persons, you have to have some U.S. regime to participate with U.S. persons. This is what we do with international banks. And I think there's a reasonable landing spot with how Tether could touch U.S. persons that is not market distorting in the way that some domestic stablecoin companies want the policy to be constructed. So I think there'll be a rational outcome there, and I think we'll get sensible law. It just may take a few months to do that.
Now, want to go back to one point that you made in particular. I think it's fascinating, the politicization of the agencies, or viewing them as the person in charge versus the agency in charge. I would love for you, Russ, to react to that, because there's a lot of questions around how the agencies navigate moving forward, particularly in light of the DOGE cuts. We've been talking about this, particularly in the striking down of Chevron doctrine here too. So how do you see the role of the agencies played out, particularly after the experience that was just had in Congress, where the person was pushed back against, not necessarily the agency in every case?
Yeah, look, there's 535 members at any one time, maybe a few less depending on who's in their seat or not. You're not going to please everyone, and you have authorizing committees and specific people you report to. I did not report to Patrick. I reported to the Ag Chair and committee, but Patrick and I have a strong relationship.
You didn't report to anyone, Russ. You're an independent agency. You were kind, though. You're a kind person, and it felt like you were consulting.
A little bit of an exposure of how the relationships work. But point being is that you had a lot of members of Congress. You did the job the best you could. You worked within the mandate you have and what you had to do from a mission standpoint. And it was challenging, right? Because especially a lot of things that were quite unsavory, and you were trying to manage as you go, all the while striking with this idea of innovation and growth and the constituency of members of Congress, or the constituency of players in the space who wanted a sandbox to play in, right? Metaphorically. So never easy, an imperfect system, and one where you're trying your best to live within a very, very discrete set of rules drafted by Congress, every single one of them you care about deeply, but ultimately seeing this changing technology, which is just blowing the rules and the law out of the water. So then you talk about Chevron and the new sort of standards between Congress and the agencies, it becomes even more difficult, right? Because I said this earlier, and this is an area where Patrick and I will not necessarily agree, but we have a healthy debate about it, is where is that line and how do you strike that line between prescriptiveness from Congress versus principles from Congress? And I will always argue that more principles-based regulation is healthier, not only for the agency to be able to sort of exert some level of flexibility as markets evolve, but also to not necessarily be subject to a very, very, discrete and finite legislative mandate, because it will never work out in the long run as markets, crypto or otherwise, change.
More directly, are you worried about the erosion of power at the agencies?
Yeah, look, I've said this before, and I will say it ad nauseum. U.S. capital markets are the best and most desired in the world because of the regulatory structure, the rule of law, and the accountability for bad actors. The reason that large financial institutions play in our markets and are successful is because there is a rule of law. And when you see the degradation of the agencies, market or otherwise, it gives me a lot of pause, because I know the individuals from top down who worked at the CFTC and are facing a lot of challenges right now. And it's relationships and communications with the regulated entities. You need to be able to call the agency and say, I have a question about a specific issue we're having, or we're trying to build a business, or what's the status of the license application we have? What can we do to speed it up? And that doesn't even speak about the law enforcement side, which if you don't have people, you're not going to be able to bring out and expose the bad actors. Now, there's always a line. There's another side of that argument, which I'm sure Patrick would be happy to take. But ultimately, you have to find and strike the right balance between moderation, thoughtfulness, complying with the law, but also having the tools. And that's personnel. That's not just financial resources. That's personnel to implement and enforce the law. And if we lose that, what worries me is that trust, that integrity, that depth of interest in U.S. capital markets. Does it begin to fracture? We're a long way from it, but these are the micro steps that I am concerned about when I see a lot of individuals I used to work for fleeing for the exits.
We only have about a minute left here, so we'll leave you guys with the final words. I know we were kind of joking earlier, but maybe we could make it happen. Part 2 later this year, maybe when we have more rules under our belts. But yeah, final words. I mean, what are you looking for? You had a name for what you called this summer, Patrick.
Yeah, the wicked hot summer. So I think a conversation like this shows that there aren't just flashpoints in policymaking. There are all these subtleties. Russ talked about his view of Congress giving the agency principles to go base their policy around, and this was his pushback on how I was trying to craft Fit 21 to be quite prescriptive to the agency, and it was built around I think the Gensler leadership of the Securities Exchange Commission to award against it. And Russ came in and said, well, you're actually going to create a tighter box for innovation as well. So let's think these things through. That's the healthy kind of push and pull that we need to have in policymaking, but you got to be able to talk to each other to do that. And I think the great thing about what's happening with digital assets and crypto right now is that you have Democratic members and Republican members of Congress want this innovation to take hold, see the value in it, and want to support the policymaking initiative around it. We haven't seen this in a long time in financial services policy. And I think this is a very quite welcome thing in an otherwise kind of crazy Washington right now. I think that's a healthy and good thing. The specifics do matter, but we can debate the specifics. We should not debate, though, whether or not we need sound law in order to get the good out of this innovation. I think we need that. And Russ and I are aligned there, and we talk a lot about that, about the policymaking apparatus and how to get that done. And this is a healthy and wonderful thing, which is why I so enjoy being a part of the Passero Center at Georgetown, that we can have these discussions and we can talk to the students about how the world of finance and policy intersect, and how vibrant that is sitting in Washington, D.C., with a view to New York and the world.
Russ, final word.
So just quickly, look, the Passero Center brought Patrick and I together after our public service careers. Patrick's longer than mine, but it's been a great couple months where we've been able to bat around ideas and continue the conversations that we had in a nonpartisan way, bridging that divide between policymakers, elected officials, regulators, and practitioners. I just think over the next couple months, as much as the environment is much more favorable, arguably, from an industry standpoint, Patrick made this point, that is not reason to rest on the laurels. I think regulation and comprehensive oversight of this industry is key. It will benefit it in the long run. And from my standpoint, in my former job, it will benefit regulators' ability to protect customers, to create a healthy, transparent marketplace, which I think in the end will, as I said, benefit the industry, but our country as well. So a lot more to come. Look forward to a fall version of this as the rules get perhaps clearer and more debates between Patrick and I over the next couple months as well. Thank you.
Absolutely. Well, thank you both so much. And thank you to the Georgetown Saros Center for Financial Markets and Policy, and to Professor Reena Agarwal for setting all of this up. We really appreciate it.